Excellent. So thank you everyone for joining us today. I'm Duran Whitman, the founder of the Algorithmic Traders Association. So I'm very happy you accepted our invitation. I see that we have a good crowd today. I hope you enjoy this presentation on the market as a multitude of humans by Alex Christoph, our Director of Education. Alex, please go ahead.
Thanks, Doran. Good morning or good afternoon, everyone, and welcome to the continued educational webinar series by Algorithmic Traders Association. My name is Alex Christoph. I am the Director of the Educational Programs with the Association. And this webinar will be very unique because I'm not going to provide a single example from trading, price forecast, or any other market-related subjects. We will explore the very low-level foundation of markets, and we'll try to understand whether it's at all possible to use mathematical models to describe its behavior, and if yes, then what kind of models we should consider. I believe that you have already understood that today we're going to discuss mostly the psychological component of markets. And we are going to do that in an unusual way. Traditionally, when it comes to the discussion of market psychology, only psychology of individuals is considered. I guess you are quite familiar with concepts of greed and fear, risk aversion, and unjustified hope. Without any intention to argue the importance of market psychology on the lowest level of a single personality, let's instead try to look at markets from the mass psychology standpoint and see whether it may bring us some fruits. Of course, I don't mean to be the pioneer in mass psychology studies applied to markets. Moreover, by no means do I claim to have expertise in psychology. However, even at a layman level, it is quite possible to use the very basic understanding of this interesting phenomenon in order to identify many common mistakes made by systematic traders, algorithmic trading system developers, and even risk managers. So, what for are we going to use this quite basic analysis of mass psychology applied to markets? Our only goal today will be to sieve numerous quantitative market models and understand which of them should be set aside as not adequate and which of them may deserve most of our attention. First of all, let's start with some definitions. Let's call a natural phenomenon something that regularly happens in the world around us and does not depend on our will. In contrast, let's call man-made phenomena something that happens exactly due to our will. For example, rain, snow, tides and ebbs, moon traveling around the earth, all these are good examples of natural phenomena. And anything from irrigation to satellites blinking at night across the sky, they are all man-made phenomena. For those natural phenomena that are persistent throughout millennia, we can develop mathematical models that describe them with a certain precision. For example, classical mechanics very successfully describes motion in the macro world. Electrodynamics describes the world of electromagnetic waves, and so on. Every model describes a certain phenomenon or a class of phenomena. And the most important point here is that these phenomena are totally independent of our models. Indeed, apples fall on Earth not because of the Newton's law, and you can listen to radio or see light not because of Maxwell's equations. However, for phenomena with human origin, the situation is different. Man always endeavors to make things work exactly the way he wants, and therefore phenomena of this type become very predictable, or better said, most of them are supposed to be very predictable. Indeed, every day we receive evidences that support this idea. Well, just look around. An electric kettle will switch off when the water boils. If you put on brakes, the car will stop. However, when it comes to man-made phenomena that involve man himself, the situation starts to become a little different. A classical example of phenomena in which humans are totally involved is, of course, advertising and marketing. There is a huge industry that works day and night to form something that is called public sentiment. Remember this term. We will use it further in our review of activities in the market. At this level, these man-made phenomena look very similar to those that do not involve man, like we have discussed. And the key similarity is, of course, in predictability of the action-reaction pattern. Indeed, were it not for this predictability, marketing would have never worked. We are all affected by it, and most of the time we don't even notice it. For example, if I tell you, imagine a can of sparkling water, I bet most of us would imagine it produced by either Coca-Cola or PepsiCo. Now, if we need to ask one important question, is mass psychology so stable, or speaking in mathematical terms, stationary, that is always so predictable? Is it possible that there exist certain circumstances under which this action-reaction chain would fail? Let's consider a simple example. Imagine yourself right in the middle of a marketing campaign that promotes banana from the North Pole. Well, perhaps it's not absolutely impossible to grow banana even there, I guess, given the modern developments in technology. You are offered Nordic banana in cafes, restaurants, supermarkets for breakfast, lunch, and dinner. Will you buy it? Most likely you will, and so would I, simply because it's so exotic. But if this banana turns tasteless, then it's highly unlikely that you buy it again. Now marketers may try another product placement strategy. For example, they may introduce an idea that Nordic banana will make you powerful or very healthy. In this case, they will still lose a good deal of consumers that won't believe it. But there will be some that will go on buying Nordic banana in order to gain health or muscular power. And yet even this group would rather stop buying these bananas when they realize that they don't get the benefits promised to them. So why have we considered these very simple examples from marketing? Here we come to a very important concept that we call confirmation of expectations. Any public sentiment should be confirmed, and only this confirmation maintains the very sentiment. When such a confirmation cannot be received, the public sentiment starts to fall apart. In the former case, it happens quicker. In the latter case, it takes longer time, but lack of confirmation of expectations eventually changes the sentiment, sometimes to strictly opposite. In order to understand the most important part of today's webinar, let's use some schematic illustrations to what we have already discussed today. Let's call those that create the phenomenon initiators, those that participate in the phenomenon participants, and non-human participants as objects. A natural phenomenon can be illustrated as a system where there is no connection to humans. Such a phenomenon had always happened independently of humans and will happen this way. Therefore, we don't have neither initiators nor participants in this system, only objects. A man-made phenomenon that does not involve participants can be illustrated this way. We can see that there is a connection between the initiator and the object now, but this connection is only unilateral. Our example with forming a public sentiment requires a more complex illustration. You can see that there is a group of initiators that actually form this sentiment. But for the sentiment to maintain, it requires confirmation of expectations of participants. Therefore, this system gets a number of feedbacks, which you can see in the picture. The strength of these feedbacks determines the stability of the system. If marketers carefully listen to the feedback from the crowd, they could potentially adjust the marketing campaign to meet the expectations of consumers. And if the marketed product is something more edible than Nordic banana, then most likely the feedback from the product itself is also strong and again helps maintaining the stability of the system. Let's now see how all our conclusions can be applied to markets. If we look at a market that is simply a multitude of humans, we could see that it's simply a part of society, and all action-reaction patterns that we considered before work here as well. In this case, initiators are newsmakers, analysts, economists, and other similar market participants. Participants are traders of all kinds in very general, broad sense. And the objects are simply performance results. If the performance is good, then the participant receives the confirmation of sentiment, the confirmation of his expectations. He expected positive results from his trading, and he got it. Therefore, he will allocate even more money to the trading method he is using. If the performance is poor, then the confirmation of sentiment is weak, and the allocation to it reduces. We can see that such a feedback in the market may amplify allocation to a particular method, thus making it more and more valid. This sounds like a paradox for many traders, that very well-known methods may work and sometimes work even better than newly discovered. Now we need to note that all these models still follow a simple action-reaction paradigm, because initiators are not involved in it. Indeed, it's hard to imagine that marketers of Nordic banana trust in their marketing themselves. But what happens if they do? The market is not a simple linear action-reaction chain as we considered in our example from marketing. First of all, both initiators and participants are numerous, and the trading methods are also numerous. They generate trades at various frequencies. They suggest to hold positions for various time, and since they're so numerous, it's hard to distinguish their traces with simply visual chart analysis. This way, we're approaching the model of the market as a multitude of humans. As you can see, it's the most complicated and tangled model because both initiators and participants are involved in the same process, and at times they even may swap their roles. We can see a great number of feedbacks, confirmed and unconfirmed expectations, and the whole picture, even in such a simplified form, looks really weird. No wonder that understanding of this complex market structure led to introduction of chaos theory to market analysis. In essence, this theory explains why dynamic systems like market sometimes get self-organized and exhibit clear, non-chaotic behavior. For example, during stock market boom, most of people buy even higher, and yet everyone seems to be in profit. A typical example of a dynamic system that has got self-organized. However, only temporarily, I believe now you would have better understood why many simplified market models, especially in the popular literature, are incorrect to say the least. I remember an illustration, a very encouraging, motivating example, where trading the market was compared to driving a car. At first it looks like you have no idea how to do it, but then you realize that there are roads and road signs, and driving a car becomes a pleasure. And the motivation idea was that you would be able to do the same in the market once you are familiar with this roadmap. As you can see now, this model, although indeed very encouraging, is completely misleading. A correct model should be a desert without roads, road signs and traffic lights, extremely overcrowded, half people drive forward, half people drive only reverse, and the main goal is to blow another car and evade from a blow at the same time. To my taste, this is an experience that is, how to say, at least not for everyone. Now, enough with picturesque illustrations. Let's see how understanding of market as a multiple of humans, even at this very basic level, could help us doing something valuable. At least, we can now critically review most of the technical trading approaches and see if they are adequate to the market itself as it is. Let's start with classical technical analysis. It's interesting that although head and shoulders, double tops and double bottoms are old as world, these classical patterns and something more from classical analysis still work. It happens because of these very feedbacks with confirmation of expectations in our model. Do you remember it? The more people are convinced that a certain pattern works, the better it will work. The key problem here is, of course, that in most cases, these patterns are clearly seen only in hindsight and very hard to distinguish. Physical models. Something that used to be very popular somewhere around 1990s with the growing market computerization, improved access to markets and availability of historical data, a lot of mathematicians and physicists came to trading. Why? In my opinion, mostly because price charts may resemble anything to a specialist that spent his life researching other, mostly natural processes with visually similar representation. But I hope you heard that I try to emphasize visually here. Unfortunately, there is no further resemblance between price movements and any natural physical phenomenon. And there is no wonder. Just remember how markets are organized and how we schematically explained the natural phenomena and the difference between them. Adaptive models. This was a further development of physical models applied to markets, and therefore there appeared adaptive models. The idea was quite simple and at first glance working. If our model stops working after a certain period of time, then let's just adjust its parameters periodically to fit the model to the market. I hope you all understand that in this case, it's much more probable that the adapted strategy will always lose, as there is a great chance that market will change right after the adoption period. Predictive models. The motto of this research paradigm is obviously the rephrased ancient Chinese proverb, let's find a black cat in a black room and we will find it there, even if actually there is no cat at all. A predictive model ignores the very market structure. It treats market data as time series in which it tries to find any more or less repeating patterns without even trying to understand why these patterns appear at all. Now we can see why such an approach can be the most dangerous. As soon as the market is restructured again, and this is something that happens almost every 3 or 4 years, these patterns will be nowhere to be found, or even worse, the following price development may change to strictly opposite. So, what is then the ideal trading strategy that would comply with our understanding of the market as a superposition of humans? As you can see, a single unique strategy of this kind simply doesn't exist. Instead, it's far more productive to create a number of strategies, each corresponding to specific behavior of every individual market participant, or rather every class of market participants, because of course it's impossible to create as many strategies as humans in the market. In this case, strategies are very simple in their structure and therefore understandable and, no less important, easily manageable. At the same time, if you trade a set of strategies along with understanding the changes in patterns of behavior of market participants and the reasons that cause these changes, then not only risks are highly diversified. It is not a problem to switch on or off certain strategies when market conditions change without rebuilding the whole market model. As you can see, this approach is very beneficial, although I have to note that this approach is always beneficial in any domain of research, and I honestly don't understand why trading should be an exception. I mean that we should go to live trading only exploiting the processes that we understand and taking risks that we can manage. This is exactly what I teach within our Certified Algorithmic Trader course that is intended for traders, system developers, fund managers, and sophisticated investors, because investors should also understand the markets they are investing into. Now, I'd like to say thank you for your attention, and in case you need more information about our educational programs and certification, please feel free to write to info@atssn.com. You can also do that by filling out the form at the classes page of the site. And now, the main part of the webinar is over. Again, thank you for attending. But for interested attendees, I'm going to say just a few words about the CAT course program. So, if you want to learn more about it, then simply please don't leave this webinar. Please stay in tune. Okay, so let's suppose that everyone that is staying now with us is interested in learning more about the CAT certification and educational program. Okay. The program consists generally of three main stages. The first stage is all about market analysis in a way that is very similar to what I explained today. The second stage is mostly about design of trading algorithms, backtesting, and optimization. And the third stage, the final stage, is about portfolio design and risk management. Within the first stage, we start with the analysis of market as a superposition of humans, of actions, of patterns of behavior. We also learn how to identify ideas that work in the market. And all these ideas are, of course, strictly connected to actions or market processes that do exist in the market. So we're not going to invent a new complex mathematical model. Instead, we do a proper market research to identify those market participants that actually drive the market. And finally, we learn how to convert these ideas into codes that can be run, backtested, optimized, and applied to live trading. Within the second stage, this is exactly what we do. We learn how to do backtesting properly so that the results would be adequate and indeed represented something realistic that corresponds to real market environment. And also we learn to use optimization not as a means of curve fitting. I bet everyone heard this ugly term, curve fitting, but to use optimization as a means of research to find reliable combinations of parameters and understanding why they are reliable and why such a system could be indeed adequate to the market and stable. And finally, as the advanced stage, we learn how to create portfolios that consist of numerous markets and numerous strategies, how to manage operational and systemic risks, and as a part of that, how to identify the moment to switch off a trading system. I think that those of you who already tried to trade and perhaps suffered in 2013 and 2014, last 2 years, know it very well that the moment to switch off a system, a proper choice of such a moment, is no less important than correct exits and entries. A few words about the requirements. The course takes 3 months. It consists of weekly online classes that take approximately 1.5 or 2 hours. We work in a very small groups of no more than 3 students, and we're trying to combine the students in a group according to the similarity of background, similar knowledge, similar skills, initial, and so on. Of course, some very, very basic mathematical background is required. I mean only in terms of understanding the basics of statistics. And of course, some basic programming skills are also required. If you have any more decent background in programming, this is a great plus. And if you chance to work with TradeStation or multi-charts in easy language, it's again a great plus, because all samples, all examples, strategies that we consider during the course are written in easy language. I'm doing that because this language is most closer to the spoken English. It is so versatile, so clear and transparent that it makes no problem to translate it further into any programming languages if you are able to work with this programming language. So basically you can use any trading platform that you like, but in this case you have to master this platform. You have to be able to correctly translate the codes written in easy language, or you can consider it as a pseudocode, if you want, into the programming language of your platform. So this is it about the outline of the course. Of course, if you are interested, and I'm pretty sure that you have further questions, please send us a message to info@atassn.com or visit our site, atassn.com. And now, for those that are still here, I would be happy to answer questions if there are any. There are only general patterns. If you, for example, the person who can break the rule, the patterns won't work. Well, what I try to explain is the understanding that this large dynamic system, as market is, from time to time is organized so that some of the patterns become prevailing. Of course, it doesn't last for long or forever, because, as I said, even the initiators in this model are affected by both feedback from participants and from objects. And therefore, at times, even, for example, imagine a situation when a newsmaker stops to trust what he's saying. This could be the turning point. Again, lack of confirmation of sentiment will ruin this model, and the dynamic system returns back in its initial state of chaos. Can you provide an overview of the type of market analysis you teach in the course? This is exactly what we do. We identify those market participants that are important for markets. Important in terms of they are able to move the price somewhere. And then we carefully analyze under which conditions they may move the price, for how long it could be, how long does it take to move the price for them, how important it is, what's the probability of it. And based on this knowledge, we design a number of relatively simple algorithms that describe the behavior of each important class of market participant. Then we just develop each strategy that supports this repeating pattern and combine them into a portfolio finally. This is the essence of the method. Do you deal with systems for institutional traders with much bigger sizes? Since we have never spoken about any trading size during this webinar, then I simply don't understand how to answer this question, because I don't understand what is much bigger size. Could you be please a little bit specific? Follow doesn't involve order book analysis. No. Order book analysis, at least in my opinion, is useless already for a number of years because of a lot of algorithms that are used to mask the actual liquidity, to mask the actual intentions in the market. So order book analysis, especially, look, most of the algos, ready-made systems that we consider during the course are intended for FX and index futures. With index futures, yes, you can get to an actual order book, but with FX, it is hardly possible. Therefore, we don't need to use order book analysis. 100, 300 lots for gold future, for example. Some of the strategies, well, first, most of the strategies that we consider are relatively slow traders. This means that we hold the position for a number of days. It's normal, or 1 day or 2 days. And what is particularly good about it is that the average trading value of the average trade value is relatively high for these strategies. So it's not like high frequency trading when you regularly try to earn 1 tick. And therefore it is possible to use these strategies for a very popular kind of institutional trading, that it is generating entries, but the further processing of the actual fills is made by execution algorithms. You can use anything that you like. And slippage in the execution is important. Well, if you trade 100 contracts gold future, it's always best to use execution algorithms, because the slippage will be so high that you will be really upset. Did you say index futures? Yes, I did. Thank you. Well, thank you as well. Hope I answered your questions. More questions? Okay, suppose there are no questions, so let me again say thank you very much for attending today's webinar. Don't forget to visit our site at atissm.com to write any comments, suggestions, and questions to info@ atssn.com to watch previously recorded webinars at youtube.com/atssn. And of course, don't forget to reserve your seat for upcoming webinars that are regularly held on Wednesdays. So stay tuned. Thank you very much and have a good day.